Making sense of financial results can often feel like, well, trying to navigate a bustling marketplace with a blindfold on. But what if we could give you the map, the interpreter, and maybe the shortcut to those aha moments? That's exactly our mission today. We're taking a deep dive into the unaudited financial results of UCO Bank for the quarter ended June 30th, 2025. This isn't just about parsing raw numbers. It's really about understanding the pulse of a significant financial institution, one operating right at the heart of, one of the world's fastest growing economies. Our insights today are distilled from a stack of detailed sources: the official financial presentation, their press release, the outcomes from the recent board meeting, and also some targeted questions that helped us really focus our analysis.
Precisely. Our goal here is to synthesize these diverse documents to cut through the jargon and highlight what truly matters for you. So not just what figures changed, but why those changes are significant for grasping broader economic trends and UCO Bank's strategic direction moving forward.
Okay, so before we zoom right into UCO Bank's balance sheet itself, let's maybe paint the broader economic canvas of India. Because, well, that's the ocean this bank is swimming in. What's the big picture telling us about the strength and trajectory of the Indian economy right now?
Well, what's truly fascinating here is how resilient and robust India's key economic indicators continue to be. We're seeing sustained strength, particularly in the services sector, and also high-value manufacturing. The country has significantly expanded its global trade footprint, and that's driven by enhanced industrial capacity and competitiveness in services, alongside a notable rise in strategic sectors like defense production and electronics. So this robust environment naturally makes us wonder, what are the leading economic forecasts predicting for this trajectory? Well, the International Monetary Fund, the IMF, projects India's economy to grow at 6.3% in 2025-26. That solidifies its position as the fastest-growing major economy globally. And this forecast comes on the heels of improved consumption prospects, especially in rural areas, which is a key driver, really, for domestic demand. The Reserve Bank of India, the RBI, mirrors this optimism. They're forecasting India's GDP growth rate for FY 2025-26 at 6.5%. And they give quarterly estimates showing pretty consistent growth: Q1 at 6.5%, Q2 at 6.7%, Q3 at 6.6%, and Q4 at 6.3%.
Okay, consistent numbers there.
Yeah. And another critical measure of economic stability, India's foreign exchange reserves stood strong at USD 697.9 billion as of June 2025. To put that in perspective for you, those reserves are enough to cover more than 11 months of goods imports. That's a substantial safety net against, global economic shocks. And quickly on the trade front, the cumulative value of merchandise exports during April-June 2025 was USD 112.17 billion. That's a positive growth of 1.92% compared to the same period in 2024.
That sounds like a powerful economic engine, clearly. But India's growth story has often contended with inflation worries. How successfully has the economy managed to keep a lid on rising prices this past quarter?
Well, Consumer Price Index, or CPI, inflation in India has remained impressively below the target of 4%, actually for the fifth consecutive month in June 2025. Specifically, India's CPI inflation eased from 2.82% in May 2025 down to 2.10% in June 2025. That marks the lowest year-on-year inflation rate since January 2019.
Wow, 2.10%, that's quite low.
It is, and this sharp decline is primarily attributed to a favorable base effect from the previous year, coupled with reduced inflation across various food categories, things like vegetables, pulses, meat, fish, cereals, sugar, milk, and spices. Looking ahead, the RBI forecasts retail price inflation for FY 2025-26 at 3.7%. Their quarterly estimates show a gradual uptick, but it's still remaining well within comfortable limits. Q1 at 2.9%, Q2 at 3.4%, Q3 at 3.9%, and Q4 at 4.4%.
Okay, so a pretty stable inflation picture then. Given that promising economic landscape, how did UCO Bank, as a key player, translate those macro tailwinds into its own performance in Q1 FY26? Let's start with their top-line figures. How much did their total business actually grow?
Right, so UCO Bank's total business saw some significant expansion. It grew by 13.51% year-on-year to 5,023,736 crore as of June 30, 2025. Now, this is a substantial leap from the 4,061,408 crore reported back in June 2024. What's important to understand here for you is that this strong growth isn't just, the market lifting all boats. It indicates UCO Bank is actively and effectively leveraging that positive economic environment we just discussed. They're translating it into tangible business expansion.
13.5% growth. That sounds impressive on paper, but how exactly did they achieve it? Were they primarily lending more or attracting more deposits? And what does their lending volume tell us about how efficiently they're using that deposit base?
Yeah, good question. The growth was indeed powered by sort of a dual engine. Both gross advances and total deposits contributed significantly. Gross advances, which is essentially the loans they extended, increased by a robust 16.48% year-on-year. That reached 2,025,101 crore. On the deposit side, total deposits grew by 11.37% year-on-year, hitting 2,098,635 crore. Now, to your point about efficiency, their credit-to-deposit ratio, that's a crucial metric showing how much of their deposits are converted into income-generating loans, it stood at 75.38% as of June 30, 2025.
Okay, 75.38%. How does that stack up?
Well, this figure falls precisely within their own stated guidance range of 75-77% for FY 2025-26. So it indicates pretty well-managed capital deployment. They're lending out what they expected to.
Right. Business growth is always a good sign, but for many of our listeners, I think the real measure of a bank's health comes down to its profitability. How did UCO Bank's bottom line, its net profit, stack up this quarter?
Okay, net profit. For the quarter ending June 30th, 2025, it landed at 607 crore. That marks a solid growth of 10.16% year-on-year, up from 551 crore for the same period last year. So that clearly indicates a healthy improvement in their bottom line. But before we dive deeper into net profit, it's probably worth noting the operating profit too. That's a key indicator of a bank's core performance, before accounting for provisions and taxes. Operating profit for the quarter stood at 1,562 crore. That registered an even more impressive growth of 18.24% year-on-year, up from 1,321 crore last year.
18% growth in operating profit.
Okay. That suggests strong core performance.
Exactly. It suggests strong operational performance at its sort of fundamental level. Let's turn then to what many see as the absolute core of banking profitability, net interest income, or NII. How did UCO Bank perform on that front this quarter?
Right, NII. This is essentially the profit a bank makes from its core lending and borrowing, and the difference between interest earned on loans and investments versus interest paid on deposits. It saw a 6.61% year-on-year increase for Q1 FY26, reaching 2,403 crore from 2,254 crore in Q1 FY25. So this growth signals that they are effectively managing their interest rate spread. Their net interest margin, or NIM, which measures how profitable a bank's lending activities are, stood at 2.96% globally and 3.18% domestically for the quarter.
2.96% globally. How does that compare to their targets?
Yeah, the global NIM is just a touch shy of their FY26 guidance of 3 to 3.1%, but it still indicates a pretty healthy margin overall. What's also notable here is a strong performance in non-interest income. That includes fees, commissions, trading income. This segment saw robust growth of 19.42% year-on-year, reaching 997 crore.
Wow, nearly 20% growth in non-interest income. What drove that?
Well, digging into the details, recovery and written-off accounts alone contributed a significant euro 425.15 crore for the quarter. That made up 5.72% of total income. And treasury income also jumped dramatically to 198 crore from just 39 crore last quarter. So that indicates successful investment strategies playing out.
Okay, interesting. Now, let's tackle one of the most critical health indicators for any bank, asset quality. What's the story with UCO Bank's non-performing assets, their NPAs? Are they truly getting better at managing bad loans, or are there maybe hidden challenges we should know about?
This is largely a positive narrative for UCO Bank on this front. Their gross NPA improved significantly. It reduced by 69 basis points year-on-year to 2.63% as of June 30, 2025. That's down from 3.32% back in June 2024. And just to clarify for listeners, a basis point is simply 1/100th of a percentage point, so 69 basis points is beats 0.69%.
Right, useful clarification. And net NPA.
Similarly, net NPA also saw a notable improvement. It reduced by 33 basis points year-on-year to 0.45% as of June 30, 2025. That's down from 0.78% a year ago. And to give you some context on their resilience against potential losses, the bank's provision coverage ratio, or PCR, stood at a robust 96.88% as of June 30, 2025.
96.88%. That sounds very high.
It is, and it's an improvement from 95.76% a year ago. It demonstrates a very strong buffer and, frankly, a high degree of confidence in their ability to cover potential bad loans. This ratio is crucial for investor confidence. It shows the bank is well prepared.
Okay, so the headline numbers look good, but digging a bit deeper.
Right. While the overall picture is positive, it's always important to ask, where are the fresh additions to NPA actually coming from, and how effectively is the bank managing them? Fresh additions to NPA for Q1 FY26 were 608 crore. Now, the MSME sector saw the largest fresh addition at 368 crore, followed by retail at 150 crore and agriculture at 91 crore. But what's particularly encouraging, I think, is that corporate and other sectors had zero fresh additions this quarter.
Zero in corporate, that's significant.
It really is. It indicates strong performance in those larger loan books. And the bank's total recovery and upgradation for the quarter was 756 crore, showing consistent effort in managing and resolving existing bad loans. Their slippage ratio, which indicates the rate at which new loans turn bad, was 1.18% annualized. This is well within their guidance of 1.25% for FY26. So they're managing new slippages effectively.
Okay, that makes sense.
Furthermore, the bank continues to hold a substantial COVID-19 related provision of 530 crores as a contingency, just extra padding. And they're holding 100% provision against a total outstanding of 983.64 crore for accounts covered under the Insolvency and Bankruptcy Code, the IBC, as of June 30, 2025. That showcases their conservative provisioning approach. They also meticulously track loans showing early signs of stress, categorized as special mention accounts or SMA. SMA 0 means payments are overdue by 130 days, SMA 1, 3160 days, and SMA 2, 6190 days.
So catching potential problems early.
Exactly. For loans above 1 crore in these categories, SMA 0 advances stood at 528 crore, SMA 1 at 316 crore, and SMA 2 at 696 crore. And the fact that they're holding additional provisions of 189 crore specifically for these SMA 1 and 2 accounts over 1 crore shows a really proactive approach. They're trying to catch potential NPAs before they fully materialize.
That's a very comprehensive look at risk management. Now, let's just focus slightly to where the bank is actually deploying its capital and attracting deposits. What's the strategic emphasis within their loan book and deposit base, and how are they balancing these two critical areas to fuel that growth we talked about?
Okay, so the bank's gross advances, as we mentioned, grew by that strong 16.48% year-on-year to 2,025,101 crore. The truly significant growth area, and this is a key strategic pivot for UCO Bank, is the RAM segment. That's retail, agriculture, and MSME. This RAM segment expanded by an impressive 23.47% year-on-year to 1,025,927 crore.
Wow, nearly 24% growth in RAM. What's driving that within the segment?
Well, within RAM, retail advances showed an impressive 30.73% year-on-year growth, reaching 56,195 crore. This was strongly supported by home loans growing 17.92% and vehicle loans surging by a remarkable 66.94% year-on-year.
67% in vehicle loans, that's massive.
It is huge. And agriculture advances grew by 15.46% to 29,961 crore, while MSME advances saw a healthy 20.3% growth to 39,771 crore. Now, connecting this to the bigger picture for you, the bank is clearly prioritizing these high-growth, often lower-risk segments. This aligns perfectly with supporting the rural and semi-urban economic growth we discussed earlier in India's macro story. And this strategy also typically results in lower NPA rates compared to, say, large corporate loans, providing a more stable asset quality profile.
Right, so they're clearly leaning into these retail and small business segments for lending. Makes sense. But how are they funding this impressive growth in advances? What's the story with their deposit base?
Okay, deposits. Total deposits increased by a solid 11.37% year-on-year to 2,098,635 crore. So good growth there too. But while overall deposits grew well, the CSA, or current account savings account, ratio, which represents those low-cost deposits crucial for a bank's profitability, it stood at 36.91%.
36.91%. How does that compare to their target?
It's just slightly below their guidance of 37-38%. This suggests maybe a slight shift towards more expensive term deposits this quarter, as domestic term deposits grew by a stronger 13.05%. It's also an interesting detail, perhaps, that overseas deposits saw a strong 37.59% year-on-year growth, although they still represent a smaller portion of the total deposit base. Show some international diversification in their funding strategy, maybe.
Okay, slight miss on CASA, but overall deposit growth is strong. Now, beyond the raw numbers on the balance sheet, how efficient is UCO Bank in its day-to-day operations? And how well capitalized are they? These factors are often considered, the true backbone of a resilient and future-proof bank.
Yeah, absolutely. Operational efficiency indicators reveal very positive trends here. Business per employee, a key productivity metric, improved to 24.64 crore as of June 30, 2025. That's up from 21.65 crore a year ago. Similarly, business per branch also saw an improvement, rising to 158.37 crore. And critically, their cost-to-income ratio stood at 54.06% for Q1 FY26. That's down quite a bit from 57.23% in Q1 FY25.
So they're becoming more efficient.
Exactly. This indicates significant improvement in managing operational costs relative to the income they generate, which is a very healthy sign for long-term profitability.
And what about their capital adequacy ratio, or CRAR? That's perhaps the ultimate measure of a bank's ability to absorb potential losses and signals its capacity for future growth, right?
Absolutely crucial. UCO Bank's capital adequacy ratio, CRAR, stood at a robust 18.39% as of June 30, 2025, and their Tier I capital ratio was 16.36%. These figures are comfortably above the RBI norms and unequivocally demonstrate the bank's strong financial health. Plus, it shows ample capacity for future growth and weathering potential shocks. Looking ahead for FY 2025-26, the bank also has a proactive capital raising plan of up to 2,700 crore in equity capital. This indicates their foresight in maintaining strong capital buffers even as they expand. Good to see they're planning ahead and the ownership structure. It's also worth noting the shareholding pattern. As of June 30, 2025, the government holds a substantial 90.95%. Then you have FIIs at 0.14%, DIIs at 4.74%, and others at 4.17%. For many observers, that high government holding signifies strong backing and stability.
Okay, strong capital, efficiency improving. Now, in today's rapidly evolving financial landscape, a bank's digital strategy and its commitment to ESG, environmental, social, and governance factors are becoming just as crucial as its traditional financials, wouldn't you say? What tangible strides is UCO Bank making in these areas to really future-proof itself?
Definitely. And their Project Perivarton seems to be truly accelerating their digital transformation across multiple fronts. They currently have 22 digital journeys live, with 8 more slated to go live soon. This covers everything from personal and vehicle loans to MSME and agriculture finance. And this isn't just, a list of initiatives on paper. It's translating into remarkable results. Year-on-year growth in digital advances is up 8 times.
8 times.
8 times, yeah. Digital renewals surged by 226%, and digital account openings saw a 165% increase. Digital agri-MSME sanctions grew an impressive 7.5 times. Their total digital business has reached over 825 crore. Plus, their mobile banking app is highly rated at 4.8 out of 5. That positions them as a best-rated public sector bank, or PSB, mobile banking app, which speaks volumes about the customer experience they're delivering.
And they're using AI too, I gather.
They are. They've embraced AI with their assistant named UDA. It's proficient in Hindi, English, and Bangla. UDA has handled over 8 lakh chats with a 91% customer satisfaction score, showcasing their effective adoption of AI for scaled customer service. It seems to be working well.
Okay, impressive digital push. What about the ESG side?
On the ESG front, UCO Bank has a notable exposure to renewable energy, with 3024 crore in advances dedicated to this sector. They offer concessions for electric vehicle purchases and have mobilized 55.81 crore in green deposits, clearly aligning with sustainable finance goals. Beyond just green initiatives, they're actively promoting financial literacy. They educated over 46,029 persons via financial literacy camps and a massive 5,019,412 persons via Center for Financial Literacy initiatives just in Q1 FY26.
That's a huge number for financial literacy.
It really is. It's a significant contribution to financial inclusion across India. And finally, their commitment to cybersecurity looks robust. They operate an RBI-aligned framework, have a 24/7 Cybersecurity Operations Center, or CSCC. They hold ISO 27001 certification, and they use an AI-enabled mule detection system basically for detecting potentially fraudulent accounts with an 88% success rate. This provides a tangible layer of security for your digital banking experience.
It certainly sounds like they're making significant strategic moves across the board, both digital and ESG. But how are these efforts being viewed externally? Are they gaining recognition for their performance and strategic direction beyond just their internal metrics?
Yes, absolutely. They're getting external validation. UCO Bank secured the second runner-up position in the EASE 7.0 Reforms Index under the Top Improvers category. EASE stands for Enhanced Access and Service Excellence. They also received the second position for Outstanding Performance in Digital Payments for FY 2022-23 and third position for FY 2024-25. So these awards provide crucial external validation, indicating that their strategic initiatives, particularly in digital transformation, are being recognized and lauded across the industry.
Okay, good to see that recognition. So let's bring it all together. How does their actual performance in Q1 FY26 stack up against their own ambitious guidance for the full fiscal year? Are they hitting their marks, or are there maybe areas where they need to accelerate?
Right, the comparison to guidance. On several key fronts, the bank has either exceeded or is well on track. They've exceeded their guidance for credit growth. They achieved 16.48% actual versus a 12-14% guidance range. And they're on track with deposit growth at 11.37% versus a 10-12% target. They've also performed better than guidance on credit costs, coming in at 0.84% versus their target of less than 1.00%.
Yeah.
So that's positive.
Okay, but were there any misses?
Yes, this is where it gets interesting. They slightly missed their gross NPA target. They aimed for less than 2.50%, but came in at 2.63% actual. Similarly, their net NPA target of less than 0.35% was slightly missed at 0.45% actual. And as we mentioned, the KSA percentage was also marginally below target, 36.91%, versus the 37-38% guidance. So this does beg an important question for future quarters. Despite their impressive provision coverage ratio and that overall asset quality improvement, can they push those NPA numbers down further to meet their own ambitious internal targets? Or are there perhaps deeper challenges in specific loan segments that might persist?
That's the key question, isn't it? Well, we've just taken a truly comprehensive deep dive into UCO Bank's Q1 FY26 results. We've explored the buoyant economic backdrop of India, dissected the bank's impressive business growth, its robust profitability, the significant improvements in asset quality, and its forward-looking strides in digital transformation and ESG. So looking back at everything we've discussed, what stands out to you as the most compelling takeaway from this deep dive into the numbers and strategies?
I think what becomes clear is how effectively a traditional financial institution like UCO Bank is navigating a really dynamic economic environment. They seem to be doing this by focusing on core banking strengths, especially in that strategically sound RAM segment we talked about, while simultaneously and quite aggressively embracing digital innovations and responsible banking practices. But while the overall performance is undeniably strong and shows significant progress, those slight misses on their ambitious NPA targets suggest that asset quality management, well, despite all its improvements, it remains a critical area for focused attention, especially if they want to achieve even greater financial health and fully meet their own high goals.
Right. So what does this deep dive mean for you, the listener, as you think about the broader financial landscape? It truly highlights that understanding a bank's health goes far beyond just looking at revenue and profit figures. It's really about their strategic allocation of loans, their proactive ability to manage risk, and their forward-looking investments in technology and social responsibility, all factors that ripple out and, frankly, profoundly impact the broader economy. And here's maybe a thought for you to mull over as you go about your day. As digital payments and AI-driven services become increasingly central to banking, how might a bank's physical presence, like UCO Bank's, 33055 domestic branches, how might that evolve to complement its digital reach in the coming years? Something to think about. Thank you for joining us on this deep dive. Until next time, keep digging for those insights.